Hello and welcome to our macro and strategy update. This week, we focus on the US inflation outlook and expose why we think inflation is likely to spike. We believe that in the short term, the only way for US inflation is up. For one, both ultra-loose fiscal and monetary policies will remain in place. A second point is a base effect. Indeed, last year around this time, hotel rooms were empty and airplanes grounded, while oil prices turned negative. This led, for instance, headline CPI inflation numbers getting close to zero. As a consequence, base effects will lead to spikes in this year's numbers for this reason alone. We think, however, that there is more to it than those peculiar mathematical elements. The US economy is rapidly regaining strength. The output gap is closing, consumer spending is on fire, and global supply disruptions lead to higher input prices. In the US in particular, the evidence is strong that the reopening of the economy is leading to a boom, and there's evidence that price pressures are indeed picking up. Looking at inflation numbers, the percentage of components relative to total spending with prices rising strongly, that is to say by more than 2%, is gaining the upper hand. This can be seen from the attached chart, which is drawn from data from the Dallas Fed. Now, whether inflation indices will go up temporarily, as the Fed itself suggests, or whether those rises are more structural in nature remains to be seen. But for the time being, there's clear evidence that price pressures will rise. As to practical investment implications, we maintain our very prudent view in the fixed income area. Indeed, we recently downgraded further our exposure in US Treasuries to double underweight in certain risk profiles. This represents our view that interest rates in tandem to inflation are likely to increase in the near term. Thank you for listening and see you next week.